Hey friends, welcome back to the channel. I'm Iggy from the Investing Iguana, and today we're cracking open one of the juiciest financial stories of 2025. Imagine walking into a casino and seeing someone bet $70 million against the house right before the big jackpot hits. That's exactly what Big Short legend Michael Burry just did with US stocks. But instead of roulette wheels, he's playing with entire economies. Let me show you why this matters for your portfolio. For my new iguanas, I simplify complex markets into plain English. Think of me as your financial translator between Wall Street jargon and real-world decisions. Today's menu, a $70 million stock sell-off, China's economic bazooka, and the insurance policies billionaires use to sleep at night. First, let's understand Burry's track record. This is the guy who predicted the 2008 housing crash while everyone else was busy buying beach houses with credit cards. His latest move, dumping $70 million worth of US stocks faster than a kid trading vegetables at the dinner table. But here's what's wild. He's doing this during what looks like a market paradise. The S&P 500's been climbing like it's got rocket boosters strapped to it. So why bail now? Picture the stock market as a crowded elevator. When everyone crams into one corner looking at you, Amazon and Nvidia, it gets risky. Burry's saying, I'll take the stairs because our elevator's looking wobbly. The top 4 US companies now make up 25% of the entire S&P 500. That's like 4 students doing all the work in a group project. Works great until someone gets sick. Let's talk numbers. The S&P 500's price-to-earnings ratio, that's basically how expensive stocks are compared to company profits, is sitting at 28. The last time it was this high? The 2000 dot-com bubble. Remember how that ended? It's like paying $10 for a coffee. Might be worth it if you're desperate, but you'll feel ripped off later. Burry's betting that coffee price is coming down. Now here's where it gets spicy. Instead of just cashing out, Burry's moving $55 million into Chinese tech stocks, Alibaba, JD.com, and Pinduoduo. Why? Because China's market is currently on sale. Their PE ratio? A bargain bin, 10.2. That's like finding a PS7 for $200 when everyone else is paying $800. But there's a catch. Would you buy electronics from a store that might get shut down tomorrow? That's exactly the risk Burry's taking. China's economy has been limping since 2021. Real estate crashes, people hoarding cash instead of spending. But Beijing just pulled out the big guns, a $1.4 trillion stimulus package. To put that in perspective, that's enough money to give every person in China $1,000 and still have $400 billion left for infrastructure. They're basically trying to jumpstart consumer spending with economic defibrillators. Here's where Burry gets clever. He's not just buying Chinese stocks, he's wrapping them in financial bubble wrap. Using something called put options. Think, insurance policies for stocks. He's protected 80% of his $55 million China bet. If those stocks crash, his insurance pays out. It's like wearing both a belt and suspenders. Maybe overkill, but your pants aren't falling down. Let's break this down simply. Imagine you buy a $500,000 house but worry about fires. You pay $10,000 for insurance that pays $400,000 if it burns down. That's exactly what Burry's doing with Alibaba and JD.com. Smart, absolutely. Expensive? You bet. But when you're playing with millions, a 5% insurance fee seems reasonable. Now the $1.4 trillion question. Will China's stimulus work? Their middle class is 400 million strong. That's more people than the entire US population. If even half of them start spending like Americans during Prime Day, companies like Alibaba could skyrocket. But there's a political wild card, Trump's new trade policies. Remember 2018's trade wars? They made shipping containers 25% more expensive overnight. Burry's betting his insurance will cover that risk. Here's what keeps me up at night. The US market relies on 4 tech giants, while China's betting on consumer revival through government checks. It's like watching 2 different cooking shows, one using a single premium ingredient, the other throwing in every spice in the cabinet. Both could create masterpiece dishes or spectacular messes. So what does this mean for you? First lesson, diversification isn't just a fancy word. It's like having different types of fuel in your car. If gas prices spike, maybe your electric battery kicks in. Burry's showing us that even billionaires hedge their bets. Second, understand valuation. Paying $28 for every $1 of profit, US stocks, versus $10, China, is a huge difference. It's like choosing between a Tesla and a Toyota. Both get you there, but at very different prices. Now I want you to think about this. Where do you see more growth potential? Overpriced US tech that's already dominating, or discounted Chinese stocks that could rebound? There's no right answer, but your portfolio should reflect your risk tolerance. Personally, I'm keeping 60% in stable US dividend stocks, 20% in emerging markets, and 20% in cash for opportunities like these. Before you go, 2 quick things. First, smash that subscribe button if you want more breakdowns like this. Second, check out my last video on interest rate plays. It's crucial knowledge with the Fed's upcoming decisions. Remember, friends, investing isn't about predicting the future. It's about preparing for multiple futures. Stay sharp, stay curious, and I'll see you in the next video.